Hey everybody, it's David from David in Progress, where we talk financial independence, retiring early, and doing your best to live your best life now from the perspective of someone who is trying to do all those things. Well, today is the first full week of August, and the market has crashed. The world is ending. You are doomed, or at least that's what all the headlines are saying. And for me, this is my first market crash since reaching early retirement. And so I'm going to talk today a little bit about how I am handling it. Am I feeling panicked or am I feeling peace? Let's talk about it. Well, I will say it is concerning to have this happen so early into my early retirement. If you're new to this channel, first of all, thank you so much for watching. My story, I was laid off in December of 2023. And as a result of that, decided to give early retirement a try. And that's what I've been doing. And with these videos, I am sharing with you in a very transparent way how things are going for me and my wife in this journey. Now, this is not my first rodeo when it comes to stock market crashes. They happen all the time. It is a natural thing. I've written down here just a little bit of the crashes I have experienced in my 30 years of investing. From 2000 to 2002, those were 3 down years. And in 2003, that was the first year that I wrote down my retirement savings balance. It was $49,000. So if you think about it, a 10% or a 20% drop at $49,000, it's the same from a percentage-wise, but it feels a lot less painful than, let's say, 2008 when things went down 36.55%. In 2018, it went down 4.23%. And in 2022, it was down 18.1%. When I say it, I'm talking about the annual return for the S&P 500. And I have a link with all these numbers that I'm going to place into the comment section below or in the notes. So please check that out. One thing you will notice, I just gave you 3 or 4 examples of annual down years. And of course, throughout those years, there are days when things were way up and there were days where things were way down. But as a whole, if you look at the percentages going all the way back to 2000, you can go further on the chart that you'll see when you click on the link. There is a crash. There's always a crash. After a crash, there is always, it may take a few years, but there's always time when things go back up. Now, the difference for me is that I experienced these downturns during the wealth accumulation stage. That's the time when you got your job and you're saving money. And I'll be honest, when those crashes occurred, I got excited. When the market is going down and you're saving regularly, you should be excited about these days. You're buying low. You're 3 to 5 years away from retirement or early retirement. These are fantastic times. And it's something to be really exciting or be excited about during that wealth accumulation. It is very different during the wealth preservation, which is where I am. So prior to that December 4th getting laid off thing, I was definitely in that wealth accumulation stage, very aggressive. I held very little cash. I had no savings in a bond fund, anything like that. Strictly the S&P 500 and mutual funds, low cost index funds. You can see what I am invested in a video that I posted a few weeks ago that shows my portfolio. But basically, up until then, I was very aggressive, very little cash, no bonds. Fortunately, after being laid off and transitioning to this early retirement, I did make some changes. And what I did is what is popularly known as, you know what I'm trying to say, is known as the 3-bucket strategy. So in a 3-bucket strategy, which is what I'm actually doing, I have 3 buckets. The first bucket I have is cash. The second bucket I have is total market bond funds. And the third bucket I have is in my equities. And for me, there's different ways to look at this. And there's lots of arguments. I'm not going to tell you what is right or wrong. The purpose of my channel is just to simply share what I'm doing. And in my mind. I don't have a math mind. I'm not thinking about this as breaking it up into percentages, which is probably the most popular. I'm thinking of it in the sense of years. And the reason I'm doing that is when you look at the chart as when the stock market has crashed, typically the stock market makes its way back, or if you're in a recession, comes back within 18 months to 2 years. So I'm breaking my buckets up into years. And I'm conservative. I've had some health challenges. You can see another video on that. So I probably have more in bucket number 1 than is typically advised. Bucket number 1 is your immediate access funds. And for me, that is cash and a high yield savings account. And I have 3 years of savings in that cash bucket. So potentially, if this market continues to go down and I don't want to withdraw where I am, selling from a down market, from a down bucket, which is bucket number 3, I can just take out of that cash for up to 3 years and allow time for the market to recover. The second bucket that I have is very easy. It's a bond fund. Again, I didn't have this prior, but I do have it now. You can see my portfolio video from a few weeks ago to see what I'm invested in. Basically, in my bond fund consists of Fidelity FXNAX and a Vanguard fund, which is within my 401k, which is FIPIX. Now, a couple years ago, bonds were terrible. What's supposed to happen is, in theory, is that the stock market crashes, your bond fund goes up. It doesn't go up much, but it goes up. Well, back when interest rates were going up, very unusual, the stock market was going down and the bond funds were going down. Well, I'm happy to say, or at least so far, the market and the strategy seems to be working. Last Friday and then recently, as the stock market was coming down, those previously terrible bond funds are going up. Not by much, but they are going up. So that is bucket number 2. Bucket number 3 is strictly equities. Bucket number 3 is strictly everything else. So I have 3 years in cash, as I mentioned in bucket number 1. I don't think I said what I have in bonds. I have the equivalent of 3 years into the bond fund of my expenses, and everything else is just in equity. So in theory, we could go up to 6 years before I have to take out of that equity fund. So let's say my equity fund, which is mostly FXAIX or FZROX, S&P 500 funds, let's say it goes down for a couple years. Well, then I just don't take out of it. And my cash, I can rebalance by taking out of that bond fund. And I'm just going to ignore I even have that. In theory, this is all theory, but I'm living it now. There's plenty of time to recover. So the key is 30 years of investing, many years of these drops, is to just take that deep breath and don't panic. Hopefully you have a plan. If you are retired or early retired and you're in 100% equities, you don't have any cash saved, you don't have anything in a bond fund, well, yeah, maybe this is a bit of a pucker moment for you. But if you've done your due diligence and you're a couple years away from retirement, or you're already in retirement, and you have, based on your risk tolerance, set up your diversified portfolio with cash, bonds, and whatever else you might want to do, in addition to that low-cost index fund, you're probably okay. This thing's been crashing for what, 3-4 days? This is not the time to panic. This is time to have peace, which is what I currently have. I'm not panicking. How about you? What is your strategy? Are you doing a 3-bucket thing? Or are you divided up by percentages? Are you not doing anything? So you've got the giant pile into your index fund and you're totally panicking now. I'd love to hear what your strategy is, especially if you're someone that is currently in retirement. How are you feeling today? If you're someone who's 5-10 years from now, is this something that you're thinking about? What your strategy? So many questions, and I would just love to hear from you in the comments below. Again, thank you for watching. Isn't it great to be doing all this together as the economy goes up and goes down, that we here can be talking about it and you can be seeing real life examples of how it's impacting actual real people. So thank you so much for watching.